Greek sovereign debt, but they have insured themselves. And who has insured them? Who's provided that insurance? But American banks. And they apparently are exposed to this Greek, Portugal, and Irish debt by up to about $129 billion, which is real cash they'll have to hand over to these European banks.
But at the same time, the Basel requirements are trying to get banks to increase their capital ratios. Here you have this cluster bomb of debt explosions between Europe and Greece, which could wipe out $127 billion on balance sheets in America. And this is really an interesting showdown in the global financial war, isn't it? Because you've got insurance and bonds versus CDS products in the U.S. We've seen this played out with the AIG scandal, the subprime scandal, and every aspect of the past 3 years, financial collapse, the controlled demolition. And depending on who sits at where during the collapsing financial system depends on who survives. Now, apparently, the key here is not to have Greece actually default, because then American banks would suffer catastrophic losses as compared to European banks. And this, of course, cannot be communicated to the American people because nobody in Congress actually knows what a CDS is, or even what a bond is, for that matter.
Well, yes, and Max, finally I'll say on this is that, you know, in the first Great Depression, you had the beggar thy neighbor policy of devaluing your currency. But everything was against gold then, so you could do that. Now they're beggaring thy neighbor via where does the debt blow up? Who holds the bag? Who's holding the toxic debt bag at the end of the day?
Stacey Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming your way, so sit right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Athens and talk with radio show host and blogger at coveringdelta.wordpress.com, Demetri Kofinas. Demetri, welcome to the Keiser Report.
Thanks, Max. Thanks for having me on.
All right, Demetri, here on the Keiser Report, we recently discussed your coverage of the charges of treason lodged against George Papandreou, the Prime Minister. Give us the details of this case.
Well, apparently, this, as you said, I'm a blogger and I have a radio show in New York, and this story just kind of blew up after I heard the allegations made by a member of parliament, a certain Panos Kamenos of Nea Demokratia, which is an opposition party here in Greece. It's the other party. Them and PASOK have been ruling the country over the past 35 years. And he made these accusations on the floor of parliament where he essentially accused the prime minister of acting as a foreign agent against the Greek government. And that he profited either directly or indirectly, as well as possibly members of his family and possibly members of his cabinet, from the sale of $1.3 billion worth of credit default swaps from Hellenic Postbank, a public banking arm, an arm that the Greek government has about 33% stake in, to private books, to a specific firm that he actually names on the floor of parliament, and he actually cites people on the management and people on the board. It was a pretty deafening allegation, and it was one that he was prompted to make by a certain Karatzaferis, who is a leader of another minority party in the parliament. Now, I should mention that after making those allegations and after I wrote my article, the firm that he cites came out with a full denial. That they said that not only did they not buy any credit default swap protections from Hellenic Post Bank on Greek debt, but that they didn't buy any Greek CDS period, and that they never advised any of their clients to buy any. And the MP actually did not provide publicly the evidence that he claims he has disseminated into many hands. In fact, he had gone on national television afterwards and said that no one should try to, or that he suggesting that he's been threatened and that he won't be threatened and that this information is in many hands. But we haven't seen the specific evidence for this specific firm. However, the larger context of the article that I wrote about is something that you've talked about on your show before. You've had Kyriakos Tobras on this show, and who, along with George Noulas, filed a lawsuit against the Greek government and speculators for their role in this larger financial kind of syndicate project, using the derivatives markets on the one hand, the CDS market, the insurance market, and the naked short selling of Greek bonds on the other hand, with the aid of the Greek central bank, which expanded the settlement period for shorting government bonds from 3 days to 10 days. And that kind of all plays into this whole thing, because it's not just about these specific bonds that they were bought by Hellenic Post Bank in spring and summer of 2009, and then sold in December after the new government came to power to some third party that third party has not yet been confirmed. But it's also a question of the larger question of who owns all these other derivative contracts that are bets against a Greek default. And are any of the people in negotiations over bailouts for Greece, are they owners of this? Do they have any interest in this? So there's these massive potential conflicts of interest. And one of the things that the MP asked for, besides everything else, was that the Prime Minister come to Parliament and that he provide evidence along with other people, and that effectively everyone purge themselves, or not purge themselves, provide evidence to say, do I or do I not have an interest in the collapse of the country? Because I'm involved in the negotiations, and that's a major potential conflict of interest.
Okay, so $1.3 billion in credit default swaps. There was a sale, and somebody took possession of these credit default swaps at some point during this period of time that you mentioned, and afterward there was a resale for something along the order of a $20 billion profit. Now, there is a way to confirm. Well, first of all, can we definitively say that these were sold?
I don't have evidence to support that they were sold. I actually had, and I don't make that claim in fact, on the post, on the article that I wrote, one of the things that I made a point of early on was that the numbers didn't really work out for me. I wasn't really sure how, whether he was talking about 1.3 billion notional or what, because the MP actually says that at the time that he was making the allegations, that some of these contracts that were expiring were at the time worth something like 27 billion euros, and that if there was a full credit event, that they would be worth 60. So the math didn't really work out for me. I tried to talk to people that work in CDS to explain that, and I wasn't able to get any kind of clear answers. So I don't know if they were sold from the initial sale to the firm again after that. I don't have an answer for that question.
Okay, if the CDS contracts were still held by the Hellenic Bank, then the money that the Greek government is seeking to offset their losses would be reduced, correct?
What is certain is that they sold their only umbrella before a storm. So would they have been better off? Yeah, absolutely would have been better off, because it was an insurance contract insuring against a default. And even if they didn't have a default, that insurance contract was rising in value. So in that sense, yeah, absolutely, they'd be better off net. Would it have saved them from a complete default? No, but metaphorically, it's also something that at the time that the country was most vulnerable, it was the one thing that it was directly correlated to the health of the economy, indirectly. So the more in dire strait the country was in negotiations with the IMF and with the EU, the more value this asset would have. So it's the least thing that you would want to get rid of once you've come into the government and you've looked at the books and said, okay, holy cow, our deficit is way above what we've been saying it is, our national debt is way worse, our economy is way worse, and we have this credit protection on our books. It's the one asset that we know is going to inversely correlate with the health of our economy. So you would think that if you're functioning with the national interest in mind, that you would never get rid of this asset. It wouldn't make any sense from that point of view. And that's actually a point that the MP makes. And that's why he alleges that the Prime Minister is functioning as a foreign agent, because he says only a foreign agent would sell an asset that has such national value during a time of national crisis.
Okay, now the credit default swaps are continuing to play a key role here. It has now emerged that American banks have written credit default swaps. So if Greece defaults, American banks have to pony up $129 billion to French and German banks. In other words, the French and the German banks own bonds that will take a haircut. But it's the American banks who stand to take catastrophic losses, because they're the ones who bought the CDS, if in fact there is a default. So the question is, were the American banks suckered into buying these CDS contracts in the same way that George Papadreou was suckered into selling them? Or is there something else going on?
Yeah, you know what? That's a really good question. I've been trying to figure out what the deal is with this sovereign CDS market in general for some time now, because as many people have pointed out, in some cases it's clearly fake insurance in the sense that there are CDS contracts on U.S. Treasury debt. And in my opinion, if you have a U.S. default, who exactly is going to have the capital and reserves to pay out the claims on an insurance contract on a U.S. default? So in general, to me, it's another example of this massive counterparty risk that exists in the system that I think functions as a sort of massive source of anxiety for a lot of these banks. So there's not just the greed factor, which makes them push countries like Greece further and further into debt, and they don't want to take a haircut. But I think there's also a fear that we don't even know what's going to happen if we take a 20% haircut, because not only do we have Greek debt on our books, but who's on the other end of these swaps that we've, of these credit default swaps, this insurance protection that we've taken out as a hedge to hedge our risk. So I think that's the real issue with all these credit default swaps and these and these sovereign debts on balance sheets. It's that no one really knows who's exposed and who's not exposed, and how much exposure is one bank able to deal with and how much is another bank able to deal with. It seems like we're kind of in the same place that we were at how many years ago with Lehman and with AIG and all the stuff that happened then with the counterparty risk.
Right. You referred to CDS products as fake insurance. And what came out after the AIG and the Lehman Brothers collapse was that CDS contracts are, in fact, fake insurance. For one thing, in a typical insurance contract, there's some kind of reserve against losses. With a CDS contract, there are zero reserves. So it's purely a gambling instrument that is metastasized to encompass trillions and trillions of dollars worth of speculative bets. And so to follow up on what you just said there is so much confusion about who owns what, which is what we experienced right before Lehman collapsed and the global financial collapse of 2008. Is the Greek economic financial collapse shaping up to be Lehman Part 2?
Well, that's what they're saying. And I actually did an interview recently before I came to Athens, because I'm based out of New York. That's where I have my radio show. I interviewed Desmond Lackman, who is a former economist for the IMF River Plate division that included Argentina, and he was on the sell side of Salomon Smith Barney during the Argentine collapse. And we talked about this exact situation, and he made the point that the ECB has roughly 80 billion in capital and reserves, and that Greek banks owe roughly 140 billion to the ECB, because right now, you have the ECB, which is funding the Greek central bank through the European system of central banks, and that's allowing the Greek banks to remain liquid because they're insolvent and they're able to continue to pay out. In fact, April was the fourth month over month that we've seen declines, and the central government of Greece was actually the biggest withdrawer, withdrawing roughly, I think, from 14.1 billion to 11 billion euros. So it's perfectly feasible. It's perfectly possible that Greece could be a Lehman in that sense, because it's huge if it defaults, and even if it takes a haircut. And again, that goes back to my point, which is, why are these banks so obsessed with not giving even the smallest haircut when we know that the Greek government can't possibly pay this back? And anyone that's here in Greece right now knows that the Greek economy has fallen off of a cliff. Anyone who's interested in trying to get interest payments is not doing what they should be doing, clearly, if you're a creditor. The only thing that creditors are achieving right now is they're liquidating assets. They're liquidating public companies, whether they're whether they're profitable monopolies or not. We recently, I think, sold the balance of OTE, which is the public telephone company, for something like €8 a share or something like that. And they're also looking to take land and mineral resource rights. We're hearing about rumors again, stuff that used to be considered, untrue or just rumors in the past about oil in the Ionian, natural gas in the Aegean, mineral rights in Thessalia, gold reserves in Crete. You're hearing about all this stuff now, and I think what you're seeing from the creditor's point of view is, let's try and liquidate as much as we can this leveraged buyout, hostile takeover of a country, this model that we're going to use on Greece. We're not even going to worry about the interest payments because the country's just fallen off a cliff and economic activity has failed, so nothing's going to come in. So I think that's where the focus is. It's not so much a focus on trying to keep the money flowing from there. Whatever losses they get, maybe they're just going to try to recoup them from the ECB and from the FSF and anything like that, kind of like we did with TARP and the Federal Reserve in the U.S. with QE1 and QE2 and Maiden Lane 1, Maiden Lane 2, and all that stuff.
All right. That's going to do it for this edition of the Keiser Report. Demetri Kofinas, thanks so much for being our guest.
All right. Thank you, Max. I appreciate it.
And now, if you'd like to send me an email, please do so at keiserreport@rttv.ru. I want to thank